Hello guys, for today's live I will try to be short and today we try to see the secrets that you have never heard of in investing. You can understand that when you tell anyone what is investing, you say okay, to buy stocks and to leave them for the long run, 10 years, 20 years, 30 years, and this is investing. Okay, some they invest in the stock market and they don't know that they invest. For example, then you ask them in your job, do you have like a retirement plan like 401k, which is an investment plan? And they say yes. I say, why you say to me that you don't invest in the stock market? You are investing. Okay? Now, there are others who invest by themselves. Okay? They open a broker account, they put stocks that they want, and they invest. But in general, a lot of people have vague information. They watch too many videos, and each one is giving them an idea. Here is an idea, here how you invest. Some they ask them, oh okay, go to IPOs, it means the new companies, and put some money there. Some they say, oh, try to do diversification, take off from any sector or industry a stock and you buy and then you wait. And so all this stuff we try to just go through it. Okay, we try just go through it, and I will try to help you at least explain some things that are most of the people they don't know about, and they don't know the truth about what is this investing. Okay, you can read books. You can read books that specifically explain how to choose companies, and it's very detailed books. Through the history of investing, you find thousands and thousands of books, and people who are successful in investing, and then they give you their experience. Okay, they give you the experience, and they give you their experience showing you a lot of stuff. Now, let's begin with one of the most known in USA, which is 401k. Now, 401k, they say it's a retirement plan. It means it's for retirement when you are 59 and a half, and then you can take your money without penalty. Okay, and then after that, if you want to take your money, you can, but understand that it is an income, that it is not taxed. Hello, Mike. So you understand that all the money that you put in 10 years, 20 years, or 30 years, or all your life, understand that it is not taxed. Whenever you take this money after you are retired, you take this money, whatever money you take, you should add it to your income that you have, and you are taxed. So it doesn't mean that you are not taxed. It's just a different money. You invest in it, and Uncle Sam, which is IRS, doesn't ask you for money now, but they ask you for money later when it is big. Okay, so just to understand this idea. Now, the idea of 401k investing for retirement plan is very simple. Each paycheck, we have a percentage, whatever percentage you want to put. Okay, 2%, 5%, 10%, whatever percent, and your company depends on the company. They give you a match. For example, some companies, they match 100%. For example, you put $100, they will add $100 from the company to you, and you will have $200. This is something good. Okay, this is something good because you get. This is why 401k in this matter, it is very, very good. Okay, I will just explain this very, very quick. At least you have an idea. So okay, so now we are speaking about 401k. This is just for the IRS. When you put 401k, it gives you the information on how it is done. Okay, so each paycheck, let's say you contribute, just an example, $100. So this is 100 is your contribution. Okay, this is your contribution from your paycheck. Now, this contribution is not taxed. It means there is no tax on it. And then here is your company. Okay, your company. And here it is you. You put $100 in your account, 401k account. Your company, if it matches 100%, because it depends on the company. A company matches 100%, another company, for example, 50%, another company can match 25%, depends. So let's say, here I give you some examples. If your company matches 100%, you put $100, so they add 100. Here, they add $50. Here they add $25. Okay? So all this money, even the company money, also is not taxed. So all this money, okay, is not taxed. And you should keep all this money. Each paycheck you add, it means you contribute. It's continuous. Since you are working for this company, so you can continue. You continue contributing until you stop working for this job. Because when you stop, the company will not give you any more money because you don't contribute money. Okay? So this is something general, and I know most of the guys, MRS, LD, Lieberman, thank you for your consistent effort. Welcome, Mrs. DL Lieberman 360. I'm trying to help you guys as much as I can, but in this when I say secrets, I will give you some information that most of the time you will never find, like online or people speaking about it. I will deal with that, but we just begin with the beginning. So be mindful that it can take longer. So it's not very, very quick thing. I can't squeeze it that much. Okay, so since you understand that, and this, it will be automatic. Now, this is a good thing also in 401k. It's automatic. It means your paycheck, let's say, it is $2,000. Let's say, just an example, your paycheck, or 2 weeks paycheck, let's say it is $2,000. You take $100, you put in it's automatic. It means you don't do it. Now, when you don't do it, it's very good. because you don't think about it. Because if you take $2,000, understand that most of the people, you spend all the money. Even if you have $10,000 a month, believe it or not, some people, they can't invest. They say, why I invest? I should deal with my money now. I need this, I need this, I need this service, this service, this service. So you eat all your money, and when you are in the retirement, like 60 or 65, and you want to stop working, and then you find that Social Security gives you 1,000 or 1,200 or 1,500, and then you can't live with this small money. And this is a big problem for almost all Americans now who are retired. And you see people, they are working until 80, 85, 90. You see them. You go to some places, you find very, very old people. Okay? They don't have money. Because their parents or the school doesn't teach about investing or personal finance. They don't. And this is a big problem in America, especially in America, which is a country of science, of technology. But they don't teach students how to deal with money. But they teach them something bad. Use credit cards and have debts, and then they get problems in their life. Okay? So let's continue right now. So we said that you contribute $100. The company, if it matches 100%, they give you $100, so it's $200. This money is not taxed. Okay, and then we said that the company is giving you money without you are not in the stock market. So here I will explain to you something that you might not think of. Okay, so let's go to the explanation. This idea, okay, this idea. So I explain this because it's a bit strange. Now, you invest by yourself. For example, you invest by yourself, and the 401k. What's the difference? Now, the guys who are doing 401k through their company, so the company matches your contribution. It means what? Giving you free money. And this is one of the best things in 401k. This is what we call an advantage. An advantage of 401k is that it gives you free money from the company. Okay? It gives you free money. Now, without having shares in the market. So when you are in 401k, the company gives you money without having shares of the company. This is called free money. Okay? So here, if you put $100, now this is just an example, okay? Let's say here, 401k, you put $100 plus, let's say $100 from your company. So in general, how much you have? You have $200. Now here, you have $100. Does the company that you bought shares, let's say you bought shares XYZ, this is the company that you buy shares with $100. Let's say the company is $1 share for the share. Just an example, okay? Just an example. $1 for a share. You bought 100 shares. It's with $100. So, does the company give you free money? It means they give you another $100. Does it happen? No. Okay? No, it doesn't give you. So the 401 here has an advantage. This you should know. It has an advantage that the company gives you money although you don't have shares. You don't have any shares. You don't own shares when you have 401k in the company. But they give you $100. So this is an advantage. Okay? When you invest by yourself, or when you invest in the company. It means when you invest in 401k. Now here I'm not speaking about dividend. Dividend I will speak about it later. Okay? I'm speaking here about the company. When you work for the company. Here you work for the company. Here not work. You don't work for the company. You just go online and you buy shares from a broker. So you go for the broker and you don't work for this company which is called XYZ. You buy 100 shares. The share is $1 for a share. You buy 100 shares for $100. So you do not work. So there is no free money, which is $100 that they give here. This is an advantage. Okay? So, guys, this thing that I'm speaking about is very, very important to understand the difference. Because in the future, if you want to invest, it clarifies the situation. Now, we have said that the 401k has an advantage. There is no advantage. Okay? There is no advantage. But the market, if this company, most of the time, companies give dividend. Okay? So here, we are talking about something else. We are talking about dividend of the company. Since you own shares, if the company is giving dividend, for example, I will just give you here an example, just for clarification. Okay, just for clarification. Now, most of the people who invest for the long run there are two categories of stocks. Stocks that give dividend and stocks with no dividend. So I give you an example to understand. Now, what is a dividend? A dividend is a cash payment from the stock itself. I will give you an example because a lot of people, they don't understand what is a dividend, because they get confused when they go online and they say it's the company gives you money from its earnings, which is not true. I will give you an example. Let's say Apple. Just an example. Let's say the company is $100 now, so it's not. But I'm giving you just example to give you correct example. Let's say it gives you 5% dividend yield a year. 5%. Now this 5%, you understand that it is done in 4 quarters, and if they say 5% yield in a year, what does it mean? It means they divide this 5%, okay, into 4, and each quarter they give you quarter of this 5. It means they give you $5. 5% of $100, it's 5%, $5. But the problem of dividend is that, what is the problem of dividend? Is that this $5, it is cut from the 100. It's not given from Apple. Apple doesn't give you free money. I told you before, free money, no. It is a no. You don't work for Apple. If you work for Apple, they give you free money. For example, in Apple, if you work for Apple, and you have 401k, they give you free money. But if in the stock market, they don't give you free money because you don't work for them. Now, when the times of taking the dividend, they take it from 100. So let's say 100 minus 5. So the stock will be only $95. So you are not getting free money. It is your own money. $5 plus 95, you will have your $100. So, but the good thing is that you don't sell shares, but the company gives the money from the stock itself. Now, let's say stocks with no dividend, like Facebook, for example. Facebook. So, no dividend. So, why they don't give dividend? Because they say, okay, we need all the money. We don't need to cut any money from the price. So, it will be like this. So, the only thing you need to understand is that Facebook, if it goes up, you make money. It goes down, you lose. Okay? But there is no dividend given. Okay? So, we have finished. Hello, Bakito. Thank you very much for coming. Ya Sahal Blad. Okay? So, now, we try to go to another thing. Now, 401k, where do you invest your money? And who will invest your money? Who? So this thing you should understand very well, because later, if you have a 401k or you want to invest by yourself, you should understand these things. Now, when you understand, you have clear idea what's going on. Okay. Now, let's go to the explanation thing, just to continue. Okay. Now, we said that, let's say we begin with a 401k, a retirement plan or investing plan. Now, you invest in mutual funds. Okay? Mutual funds. You can have different mutual funds. Let's say 1, 2, 3, 4. You can have even 5. You can even have bonds. You have a lot of stuff. So, all these that you see, you should pay fees. For example, mutual fund you are in, let's say we have 5. Let's say 20% of your money goes to each mutual fund. Understand that you pay fees every year, let's say 2 or 3, depending on the mutual fund. Let's say they take 2 or 3% each year. Let's say you have 100,000 in your 401k. So by December or so, let's say they will take 3%. So you have 97. $97,000. Now, where this 3% goes, or $3,000, it goes to the company that owns the mutual fund. It means as you are paying. Now, why do you pay? This is the question. Why do you pay mutual funds? Mutual funds is, we have a manager. What does he do? He chooses stocks. Let's say he chooses, 30 stocks. Okay? Now the mutual fund can do good, little bit good, this is good, the other way is bad, the other way is bad. So there is a percentage. But the problem in the 401k, we have fees. You pay fees. This is something that you should understand. Now, for example, you have $1 million. $1 million. Understand that they take $3,000 each year from your money. Either your account is good or bad. Either it is going up or it doesn't. It goes down. They don't care about your investment. Taking $30,000 each year is a big deal. Don't say, for example, oh, I have 1 million. Yes, but they take $30,000. So don't belittle this money that they take. That's why it is a terrible thing. Now, this is a bad thing. So let's make something about disadvantage. Okay, disadvantages. Now we have one, we have fees. It could be 2 or 3 or whatever they put. You should check. You can check in your mutual fund and see how much is fees. Okay. Now, second thing, bad performance. Now this, most of the people, they don't understand this idea. Now, why it is bad performance? They say to you they say 10% profit. So let's I will explain this because a lot of people, they don't understand, and it is bad thing. So they say in general 10% profit every year. So in 7 years you make 100%. Now look at this. Even if this is true, it is too bad as performance. 7 years you are waiting, and then your money will double. Let's say you have 100k. Okay? In 7 years it will come 200k. But I'm telling you that this is not true always. And you are telling me, for example, Kareem, you say Kareem, how do you say all the people, all the financial advisor, listen, try to think about these people, financial advisors and financial planners. They will tell you this. Okay? Because these guys, They have no experience in whatever investing or trading. They don't know even what is investing. But they do what they are asked from them. They are asked from them to have people to put their money into mutual funds. So they get a commission, and the mutual funds, they take 2 or 3%. Then you get a bad performance, and they say it's a good thing. You can find a lot of people talking. Go online and check, and they say in 7 years you double your money, and it is good in the market. But I'm telling you, it is too bad. It is too bad. Okay? Now, let's speak now. Okay? Let's speak now about what if you invest by yourself? How this compares? Okay? But listen, before I speak about how this compares, since I told you that 7 years you double your money, it is too bad. I will give you the proof from Dow Jones. Dow Jones is the average, like S&P 500 is the average. And this is what the mutual funds are giving. It's the average. It's not really 10% each year, sometimes 15%, sometimes 7%, sometimes minus 10% or 20%. In 2008, minus 50. Okay? So, I will show you Dow Jones right now, and we try to see if this is correct, yes or no. Now, so look at this one. Let me give you. We try to see. Let me see here. Let me see. So I'm going to just explain. So bear with me. I will put some numbers. I'll put some numbers. So 2021. So 1, 2, 3, 4, 5, 6, 7. 7. It means 7 years. So the stock or the stocks where it opens at 178. Okay? So for 7 years, okay, 1, 2, 3, 4, 5, 6, 7, all this, it begins with 178. 1, 2, 3, 4, 5, 6, 7. In 15, 178.65 in 2015. Now it's 2021, and the price is 350.57. Okay? Now, from 2015, we go down and we count 7. So it's 1, 2, 3, 4, 5, 6, 7. So 2008, it begins with 132.47. So 1, 2, 3, 4, 5, 6, 7. Okay? So in this 7, it is 2008, and the stock begins at 132.47, and it ends, the price ends in 2014, 177.88 in 2014. Okay, so here we have 7 years, here we have 7 years. So we try just to see if it is true, yes or no, what they say. Okay, and then we begin with 2013, 132. So we have 1, 2, 3, 4, 5, 6, 7. All this. So here it is 2013, and the stock market ends at 132.55. 132.55. This is what it ends, 2013. So 13 is 1, 2, 3, 4, 5, 6, 7, and it begins here 2000. Let me see, 13. Oh, no. I'm sorry in this mistake here. It's 2007, not 13. 2007, because here we begin 2008. Now, we try to see 1, 2, 3, 4, 5, 6, 7. 2001. Okay? 2001. So 1. Let me try to be clear. 2007. 1, 2, 3, 4, 5, 6, 7. It's 2001. And it begins at 107.19. 107.19 in 2001. Okay? So that is what we are going to do now is to see what they say. Is it true? Okay? Is it true what they say, these financial planners, or is it bad? Okay? So, guys, I know you are waiting, and it's a lot of complications, because all what I show is something that you can see and you can calculate by yourself, and you see what is these guys who are in the financial world. And the problem is that they have no relation with investing. They don't know how to invest, because these people, they don't invest at all. They don't trade, they don't invest. But it's just because the government gives them a license to tell you what to do with your money. But when they tell you what to do with your money, they put you into the wrong direction. That's why when they put you in the wrong direction, what does it mean? It means all your life you are working for brokers. And you are working for them because they get commission. So for me, I'm not against anyone, but I'm just trying to tell you the truth, how things work. Okay? For example, do you think Warren Buffett will hire a financial advisor or 10 financial advisors, and they ask them to they give him $500 billion and say, oh, play with it, give it to mutual funds. Does Warren Buffett buy mutual funds? He will never do that, because he is a true investor. He knows what is good for him and for the investment. That's why when you want to watch someone who understands really investing, you should see someone who understands, like Warren Buffett. He is one of the best. And if you tell him, oh, I have $1 million, I give it to mutual funds, he say you are stupid. Okay? So let's go back and explain now the thing. Is it true or no? Okay? So let's see here. In 2015 here, Dow Jones, the average was 178. It goes to 350. Okay, so 178, 65. Okay, 65, 178. We try to see if it is true what they say. 6 plus 6, 12, 13. We go here 1, 16, 17, 1, 14. It was 15. Okay, 357. So here it's nearly the same. Now here it's good. Okay, it's good. So they get their 100% for these 7 years. Okay, now let's see these years, the 7 years before these 7 years, beginning from 2014 to 2008. Okay, so 132, it becomes 177. So the stock here, 177.88, okay, minus 132.47, okay, we have 1, we have 4, we have 5, we have 4, and 0. You have made only $45, okay? So $45, it means it's really, you have only made 33% of your money from 130, just approximate, okay? 132.47, it goes only $45. It means you only made 33%. So it is not 100%. So you lost 66% of your profit. You lost it. You didn't do good. Although the years they have been going up and it's good in the market. But you didn't make money. You make only 33% in 7 years. Understand that it is 7 years. Now, let's go to the other one and then we stop, because this is what the chart give me. 17, it goes to 132. So 132.55 minus 107.19. So here 15, we have 6, 3, 12 out of 7 is 5, 5, 2, 0. $25 you made from 107. Okay? So, what does it mean? It means you have made less than 25. Let's say it is 23%. So, in 7 years, you made 23%. In other 7 years, you made only 33%. And in this year, you made, in this year's 7 years, you made 100%. Okay? So, 100, you can add 33 and 23. It means in general, in general, let's make this like a conclusion. In general, I'm not speaking. So, in 21 years, according to this, you have made around 50%. Okay? Once. So, this, according to the years, this is not a good performance for an investor. Okay? 7 years, you are waiting 7 years and then you get to 23. Then you wait 7 years, you get 33. Then you wait, then you get 100%. This percentage in 7 years, as they say, it is not what the people want. So, now, we can go thank you very much. He said this QW, what are you talking about? Please, we are talking about investing, and comparing 401k with if you want to invest by yourself. Okay, so you should follow us from the beginning because it's a lot of information. Now, Mrs. said, your points are hard-hitting. Brokers do not work in our best interest. They set up to lose for their own benefit. Education is key. Yes. Now, education is the most important thing. You should, because it is all your life and all your money. You should never let someone play with your money. You should do it yourself, even if you don't know that much, but you can succeed with education, little bit by education. You will be better than those who you let other people manage your money, and that is super. Jonathan Curley said, "Do you buy Bitcoin?" No, listen, Jonathan, in this session, although it is your question, I bought some before, but this session we are speaking about investing, but not in Bitcoin, because Bitcoin, it should be another session. So let's go and continue our investing in stocks, because this is the most people are doing their money, because Bitcoin, you invest, you do your best. But if there are bad news or government go against it, all this money will go, and understand that this is a very dangerous thing. But I am not here to talk about Bitcoin today. Okay, so thank you very much for the question. Now let's continue. Okay, let's continue. Since we have spoken about 7 years, you double your money in the market. This is what they say. If you have money and you go to a financial advisor or financial planner, understand that these guys, they have no knowledge about investing. You can get this license. You can just study. Because all these are working and they're brokers. So they are brokers. So they feed from your money and they put in the stock, in the mutual funds, because they get commission. Mutual funds, they put fees on your 401k, they get money, and that's how the business is run in America. You can find all over the world it's the same thing. Okay? Now, there are alternatives. Is that when you invest in stock market, you can open an account and choose few stocks, and then you invest for the whole life. Okay? Now, understand the advantage of investing by yourself compared to invest by 401k or so. The only good thing I told you about 401k is that the company gives you money, but your money doesn't grow that fast. And I have showed you a proof that even 7 years, they told you that 7 years you double your money. Now, the money that you have now, and after 7 years, even if it is doubled, it is just because you put more money. So you are, it's not, you have 100,000. If you stop, for example, giving them contribution, and you let it for 7 years, as we have seen in the stock market, sometimes you don't get that much. Well, we have seen by proof. You get 25%, we get 33%, and you get 100%. But most of the time, it is a very, very low performance. So your money doesn't grow naturally. Because there are fees. There are guys who are taking money from your account. Because they put mutual funds, we have a lot of stocks. So they give you the average, like the market. Okay? Like the market, like Dow Jones or S&P 500 or... So why do you put into mutual funds? You can put in, you buy an ETF like Dow Jones. They take, for example, 0.50%, and you don't give them 3% or 2% for mutual funds. But in 401k, they don't let you buy stocks, and this I will show you right now. Okay, so let me explain this thing. Okay, so 401k, so all your investment in general, it is mutual funds. So what about stocks? Now here is the deal. 401k, because it is run by a broker, he doesn't like stocks. It is your own money. He asks you to put your money into mutual funds. But what about stocks? He will say to you, no to stocks. Okay? And do you understand what is the reason? Because of stocks, you have no fees. You understand the game now? No fees in the stocks. For example, you buy Apple. You stay 30 years with Apple. Did the broker ask you for 3% each year because he hold Apple? No. There is no 3%. There is no mutual fund. That's why the brokers, they don't let you buy stocks. You say it's my money for my retirement. Why should I put in this mutual fund? He tells you that 401k is like this. And then you since the broker tells you it is the rules of 401k, where 401k it is made by the IRS. It's the IRS who made 401k. Now these rules, why they put these rules? Because they don't get that much money. Because brokers, when they take fees, they tax them very quick. They tax them, so the IRS can get money. The government, it means in general, they get money from the 401k when the mutual funds, they take fees. Okay? So you see, this is all complicated. This is the whole business. Okay? Business of sharing my money and your money and all the people's money. All they feed. It means they feed on our money. If all the people don't use, for example, 401k, and in the broker, they buy just the stocks. So those brokers who have mutual funds, they will have a problem. And if the people they understand that mutual funds are against them, here what will happen? This education will make that people will have more money than before. More money. Because the broker, he takes commission or $1 when you buy, that's it, or $2. But he can't take a percentage of your money. Okay? So that's why some 401k, they let you buy a stock which is the company stock only. Company stock. Yes, this is happened. But they limit this to 50% of all your money. You should never go beyond that, because they should have fees on your money. Because when you buy 50%, for example, you work for Apple and you have 401k. So Apple shares, you don't pay a fee. You don't pay 3%. You only pay for 50% that are in mutual funds. So guys, if you just understand this, the whole picture of business in America, it will be clear for you in the future what you should do. So either you continue with a 401k. Now there is another thing I want to tell about 401k. Okay, guys, another thing about 401k is that a lot of people, they have never checked their 401k, and this is the biggest mistake you do when you have a 401k. Okay, so you ask me, what is the mistake if you don't see? It is managed by professional. What? Professional? What does it mean, a professional? Do they go? Is there a school that teach investing? There is no. In America, there is no teaching of investing. If you want, for example, to become like a financial planner or financial advisor, you just find a link to a broker. He accepts you, and then you do the test. You study a little bit, then you do the test, then they give you, when you pass the exam, you become a financial advisor. Or you will become stockbroker. But stockbroker, does he know how to invest in stocks? He doesn't know. Because in the material that you study, it's just about the rules about the IRS, the rules about FINRA, the rules about companies, the information, protection of customers. That's it. That's it. It is a big lie that you think that he knows something in investing. If you tell him, for example, Warren Buffett has never bought mutual funds, so why you ask me to buy mutual funds? This guy in the 50s, he began investing. He has $500 billion. Okay? $500 billion. Who has his 401k goes to to 50 million or 100 million or 200 million? There is no, because it's the way of business. But a lot of people who have a lot of money, they are scared of the market. Because they are scared, they say, "Oh, I need to go to a professional." But this professional, he has no idea about investing. Just what they taught him about risk, about the thing. Okay? Yes. As the Kenyan boy said, the education is fire. The education makes you realize the truth about everything. Whenever you have education in any subject, you will discover the truth. Now, you discover the truth when you have education. When you don't have education, you will be like the masses. It's like all the masses, they go to slaughter, as they say. Okay? Now, the idea I will show you right now is that if you have a 401k, it's not a bad idea at all, because you don't know how to invest, because you are not disciplined. This is a very big problem, because when you take care of your money, you should be disciplined. Okay? Pablo, thank you, Pablo, for coming. Now, in investing, you should be disciplined. You have a goal to reach, and you should do the steps. Okay? Now, I will show you just about 401k mutual funds. And if you have a 401k mutual funds, I will try just to help you understand the thing. So let's go just to an explanation. Okay? So, now, this 401k, let's say we have 5, 6, 7, 8, 9, 10. Let's say 12, 13, 14, 15, 16, 17, 18, 19, 20. Now, all these are mutual funds. You know, mutual funds is just mutual funds. So we have a manager. He chooses stocks. And we have a lot of mutual funds. We have 1, 2, 3, 4. For example, we have 20. Sometimes the broker, what does he do when you give him his money and your money? It means your contribution. We just give an example, $100. Your company matching is, let's say, 100%. It's $100. So they put $200, okay, in, for example, 5 mutual funds that they choose. The broker choose, not you. This, please, guys, since I am explaining, please understand this thing, because if you understand it, there is a big chance if you go to your 401k, you will understand this. Now, the broker chooses some mutual funds and he leaves the other ones. Now, $200, and let's say he put $20, he buys shares in each mutual fund. If you are, and then you find here that in this portfolio, you are putting $20, 20% of your money. Okay, No, here it's $40. I'm sorry, because it's $200. I make it on 100 and then I mistaken. Okay, so it's $40 and the percentage of your money is 20%. 20%. This is 200 that you put in your portfolio. Okay, now the problem is that sometimes you find these mutual funds, they are going bad. Just one or two doing good little bit, but the others are doing bad. So you, in your many years, what you are doing, you are putting your money into the bad choice because your broker put them here. Now you ask your broker why you put in this bad mutual funds. They are in 5 years, they make 2%, for example. You find even mutual funds that are losing money and they still put your money there. And your idea that the broker or the broker is a professional. This is professional guy. This is the myth that I am talking about. Broker is not a professional. He puts the money where they get the best commission. Okay? So this you should understand. And let's make a summary. A broker puts your money where his company, the brokerage firm, gets the more commission, because the mutual funds, they are companies. And they say, okay, try to buy our mutual fund and we give you commission. So the broker is for it. He will be very, very happy to get a good commission. But the other mutual funds that they don't give him a good commission, he just forgets about them. All is about money. Now the problem is that it is you who is the problem as an investor in 401k. What is your problem is that you have never seen your 401k. What's doing? What is the mutual funds that are going up? What is the mutual funds that are going down? Where is your money put? You will have the ability to choose by yourself. Now it needs some education to understand. But you can see the chart. It's very simple. I will continue explaining this. Okay. We said that these three are going down, and this, for example, this makes 10%. This makes 15% this year, for example. Okay. This, although the market is good, this is minus 5%. Although the market is good, but the stocks that are having this mutual fund are bad. Like energy, for example, this year, last year, the other year, they are bad. So you are losing money. So you put your money, $40 each paycheck, and into a bad. This is, for example, minus 10. This is 0. It means it's in the middle. It doesn't go up, doesn't go down. Now, and then you try to see the chart for the other. You find, for example, this has gone 25. This has gone 50%. This has gone 30%. This has, for example, goes 22%. For example, this is minus 10, minus 5, minus 1%, minus 50%, minus 2%. This is plus 10%, plus 20%, plus, let's say, 13%, and plus 71%, like an exception. Okay? Now, when you open your 401k, and you go to all these and you see that those are doing excellent compared to yours, you have the ability to take these three and go and check this one or this one or this one and put your money there. Here, put your money in the good ones, okay, and avoid the bad mutual funds. Now this mutual funds, they will give you the chart, okay? Understand that they give you the chart, and when you open the chart, okay, when you open the chart, for example, I just give you an example. They give you, for example, 1 year, 5 years, 10 years. They can give you, let's say, 15 years. And they give you from the inception, from the beginning. Now, 1 year, it is minus 10. In 5 years, you get, for example, 5%. So are you going to stay with this mutual fund that in 5 years you get only 5%? It is not even doing the what the market has given you. If you put your money in Dow Jones, for example, in these 7 years, you are getting 100%. Now, if you find in 5 years or 7 years, you find 5% and here 100%, it means that even the Dow Jones is superior to these mutual funds. Mutual funds are managers. They choose stocks. Sometimes they choose the worst stocks in the market. They are just stupid people. They are just stupid. You can do better than them. Because these guys, they are called professional. But when we say professional, what does it mean? What does it mean? Professional. This, I'm telling you in general. Okay? Hello, Artkov. I haven't seen you for a long time. So, in this video, when I ask you, broker, okay, and mutual fund managers, from where do they get their education to be professional? Professional in what? Is there a school of investing? There is none. In America, there is none school of investing that teaches you. There are individuals who know how to invest according to their experience. For example, Warren Buffett, if he opens a school of investing, you should go to him. He teaches you how. But I know Warren Buffett, he will never teach you his secrets because it's competition. Okay? And even people who get to his classes, he can give them guidelines. Okay? He is professional investor. But those who are not, they are just getting the license. You can get the license. I'm telling you right now. It's stupid to think that that you study 1 month or 2 or 3, you pass the FINRA series, and you become a professional. You don't become professional. You become professional in brokerage firms. Yes, you're working for them to make them money as you work for yourself to make money. This is how the word of, what do you say, professional. But in real, they are not professional in the real investing world. Because if you ask them, do you have an investment? What are you do? Have you made money? If they use their stupid thing, buying stocks like this and put them, you will get the same as the Dow Jones or less. So these guys, they are not professional in what I mean by professional. Okay? Professional, it means you know how to invest, and you are an investor, and you have guidelines, and through your life you have made money. This is a professional. Unfortunately, America is like this. People, because they have no education, and they don't want to educate themselves, because the books are there. You can study investing, how to choose companies, what are the best things. You can choose the book that Warren Buffett has studied from it. You can. And you can be an investor by yourself. You don't need mutual funds. You don't need anyone else, because it's a matter of education. Okay? So everything is a matter of education. That's why the people who are educated, they can make money. Okay? But this professional broker is something you can get it very easily. You can you get hired even without knowledge. Okay? And you can take any degree that you have. Some people, they have no degree in anything, and they are stockbrokers. They are making 120 or 150 or 200,000 a year. It's just because this is the way people make money. But they are not investors. They don't know anything about investing. So these ideas, I'm telling you, is to explain this word. Okay? It's like a big lie in the financial world. And this is how things work. Okay? People are scared to lose money. So, especially those who have a lot of money, they say to them, okay, after 7 years, you double your money. But if you have bought some stocks like Apple, like Tesla, like Amazon, like there are a lot of stocks, you will be having not maybe in 1 year, 2 years you double your money. 1 year, 2 years you double money. 1 year, 2 years you double your money. It's not in 7 years. And even in 7 years, what I showed you before, that sometimes 7 years and you will be minus, depending on the years that you count. I have given you the proof when I begin explaining about the 21 years that we saw in Dow Jones, and I told you the last 7 years, the stock market has made 100% profit, but the other 7 years before, Dow Jones has made only 33%. The other 7 years before, the Dow Jones has made only 23%. In 7 years, are you going to put your money in Dow Jones? For 7 years, you get to 23%. What's this stupid thing? You just buy few stocks at random, you will have more money than this Dow Jones. Okay? So understand that there are a lot of things that you should understand. That's why for me I call them secrets, because if you understand just these few steps that I'm speaking to you, you should compare what is available in the market. 401k, Roth IRA, investing by yourself. So for me, if people they begin to invest by themselves, making portfolio, very small portfolio, putting money in some good stocks, good companies that they know, they follow their news. Okay, there are some people who are following a lot of companies. They know a lot of information about these companies, how they do proceed, how much money, how much money they have, the cash flow, how much loans they have, and the earnings, and they see what they are doing, what is the products, competition. All this stuff will help you choose the best stocks. And you don't need to have 100 stocks, because the more you have stocks, the more you have the average like Dow Jones. And this is Warren Buffett has said in one of his videos. If you want to watch more of his videos, he said, You can have only 3 stocks. If they are good, it's enough. You will become a millionaire in few years. Okay? This is in middle class, those who have money to put to some. I'm not speaking about regular people. Regular people, you need more money because you invest little. You invest $100 each paycheck, $200 a month. Okay? It's $2,400 a year. But stocks move fast than the market. Faster than the Dow Jones. Because Dow Jones, if I give you just the Dow Jones here, just to understand what is this Dow Jones and what is this mutual fund. So Dow Jones is the same as mutual fund here. Okay. So now let's speak about Dow Jones index. Okay. It has 30 stocks. Now these 30 stocks, you find those who go down, those who go up, those who are going up and down. Now all these stocks, you have the average. Okay? But you if you choose, for example, 4 or 5, if you choose, for example, 3 here or 2 or 3, and you choose, for example, this, let's say you choose 5 stocks. If 3 of them are good and 2 are little bad, you will have better than the average. You will have better, or okay, you will have better than the average, and your performance will be better than the average, because the average, it is the bad plus the good plus the average that doesn't do that much good. If you go to 30 stocks and you put them of Dow Jones and you put them in the chart, you will find that some good stocks, some bad stocks, and some in the middle. This is the truth about any index. Now, if you take, for example, mutual fund. Mutual funds, they change the stocks, but it's the same thing. For example, they have 50 stocks. It's the same. It's the same thing. You find some of these stocks are doing bad, some stocks are doing good, some they are average, and then he will get the average, this mutual fund. The average, it could be better than Dow Jones, it could be worse. So mutual fund manager is not in general. You can do better than any mutual fund manager, because they just choose at random. Even if they want to study, they don't know. That's why, if you want to compare Dow Jones or S&P 500 with mutual funds, you don't find that much. It's rare when you find a mutual fund is doing great. Sometimes it is just by luck. For example, someone buys all the technology of last year. You will see that his percentage is 25% or 35%, which is great. But you find someone else who bought energy stocks by themselves, and then he collapses, and he will have minus 20% of his money. But understand that these managers, the worst they can do to them is they fire them. But firing them, if he works 5 years, 10 years, he doesn't need them. He has made a lot of millions of dollars in his pocket. He goes and he do another business, or he sell cars, or he buys real estate and or he do another business. He doesn't care, because it is just, what is this stockbroker jobs? They are all about series. If you go to Finera series, you find all the series. You can do one of them, and then you work for a broker, and then you become a stockbroker. You become financial advisor. You become a financial planner. Okay? Their knowledge about investing is so small. So if you rely on them, it's the dead end. It's the dead end. No, you will not make that much money that if you do it by yourself, you will do better, because first, you don't pay fees. 401k, you pay each year. I give you an example. Let's say it is 3% each year. This is just an example, okay? If you have, let's say, after 40 years, you have $1 million in your 401k. $1 million, if they take 3%, it is $30,000 taken from your account each year. Guys, do you understand what it is? $30,000 from your 1 million. 1 million you have done 45 years working so hard and putting your money there, and then this guy, he comes and he takes 30,000 from your account each year. Another bad thing about 401k is that all the money is not taxed. Let's say you want to take this $1 million, you reach 60. Oh, you say, I have a lot of money. I have $1 million. Let's take all the money from 401k, because they let you get it out. And then you find the uncle Sam is waiting for you, because you will be charged, let's say 35% in your bracket, because you have paid a lot of money, as if you have paid a lot of money. So he will take $350,000 from your money. So your money is not $1 million. Okay? Because the money is not taxed. This is the problems of 401k. The slow performance. It means when you are waiting 7 years to double your money. If it is true, sometimes it is not. I showed you the proof. It is not. So this is some of the problems. And for those who don't know how to invest, who don't care about investing, 401k is better for them, because these people, if they are not obliged to invest, they will eat all their money. And this is the majority of Americans. That's why they stay poor. When they are reaching 60, they have no money. They have no 401k. They have no money. He doesn't invest in anything. Now, if the Social Security gives you 1,200 or 1,500, does 1,500 give you stability after you are 60? Retirement, to retire and to go travel. By what money you go to travel? And then you become sick. The insurance will be expensive. You buy a lot of medicaments, a lot of prescriptions, a lot of health issues. All your money, it's not sufficient. That's why people, they stay working. Go to any company like Walmart. You see people who are 80, 85, 90 years old, they are still working. And you ask them, oh, you are old. Why you are working? Yeah, because they don't have money. Because of lack of education. This is the problem. If this guy is 18 and someone shows him that you should invest, you do whatever you want. Do business, invest, do some education. It means you should have money to invest in the stock market or real estate or other things. But here when you speak about stock market, because it's easy. Even if you want to do real estate, you can go to real estate rates, stocks, and you can buy them and they do the job for you, and that's it. If you like, without buying houses and having the responsibility to do all the stuff by yourself. Okay? So 401k is a solution for those people who don't want to have education. They don't want. You say, why you don't just try to understand how to buy a company, what companies to buy? You say, okay, I'm not interested, man. I don't care. I don't understand. I don't want to learn. Most of the people are like this. Okay? So that's why here on YouTube, there are some people talking about investing, ideas, and so. And you can watch this guy, watch the other guy, watch the other guy, and you have some information. Then you can go to books. You read books. You understand more and more and more. And then you can begin your life, especially when you are young. When you are 20, 25, 30, 35, 40, 45, you are still young to invest by yourself. You can learn and you invest. Some people even 50 or 55, if you have a business or you have you have a good job, you can begin to invest, and your investment can go so quick because you have a lot of money to invest and to do and to work on your portfolio. Okay? So guys, I think we have finished this live. Thank you very much for coming. And I know, this kind of investing and something, it's a little bit boring. Boring because the people, they want, I have $1,000. How can I make $100,000 or $1 million in a few days? How? This is what the people are searching for. That's why it's like someone every day he buys lottery tickets. He can buy all his life and he doesn't get money like all of the others. Some they get one chance maybe, okay? But all your life you base your life on chance. This is a big problem. Warren Buffett has made, for example, $500 billion not by chance, not by scratching tickets, lottery tickets. Okay, he tries to have education, and then he works on education, and then he can make money. Okay, so guys, thank you very much for watching, and I think you have got some ideas about investing. If you have some questions, you can send me an email as usual. Send me an email, or if you have some companies that you are investing in, and I can give you my opinion for free. So I don't charge you anything. So I tell you it's this or this or this. Because for me, I like the fundamentals, but the chart tells me everything. Without going to fundamentals, I can tell you that your company is doing good or bad, just from the chart. But this needs a lot of experience. Okay, it's not easy to understand. So you need some education until you get the skills to do what I do. Okay, so thank you very much, guys, and see you next time.